There's a lot of insurance advantages of reverse mortgages. And the one we're touching upon now is it provides insurance against a decline in home values, because once you've opened the reverse mortgage, that line of credit grows independently from the value of the home.
Welcome, everybody. This is Buck Joffrey with the Wealth Formula Podcast, coming to you from Montecito, California. And before we begin the show today, I want to remind you there's a website associated with this podcast. It's called wealthformula.com. Wealthformula.com is where you go to get the resources that this community offers, including access to the Accredited Investor Club, which I encourage you to join if you have not done so, and you are an accredited investor. If you're interested in seeing potential deal flow that is not available anywhere else. Also, just a reminder, we are actively taking new members for Wealth Formula Network, which is our mastermind group. You can go to wealthformularoadmap.com and actually download a really thorough sort of introductory course for free. And then if you want to join us for our monthly subscription mastermind service, you can sign up there. There's a month for free. Check it out. Why not? Chance to talk to people of like mind and, run interesting ideas behind them. For example, this week, we're going to talk about everybody's plan for estate planning and some asset protection as well. But, this is a big topic, right? What are you going to do when you die? Are you truly prepared? Or are you going to leave your family hanging if something bad happens to you? That kind of stuff. All right. Well, anyway, let's move on with today's show. You just mentioned Wealth Formula Network, which is our online mastermind group, which you can learn at more about from wealthformularoadmap.com. Now, one of the questions in our mastermind group that we often dive into is, the question of whether or not you should pay off your mortgage. Now, it's actually a pretty complex question, but let's unpack the math and the emotion, and then you can potentially, think about it for yourself and make a decision. Okay. Now, first, it's important to kind of understand what a mortgage is, right? It's debt, it's leverage, but it's a lever, right? So with just 20% down, for example, you could control 100% of your home's value. So say your house is a, $500,000 property. That means you put down a $100,000 payment. Now what happens is over time, the value of your house will presumably go up. Hopefully it goes up. And that actually magnifies the appreciation. So if your home value rises 4% in a year, your equity in that $500,000 home would go up by about $20,000. Okay, and so that's effectively $20,000 is a 20% return on that initial $100,000 you put down on that property. Now, what if you had no mortgage and you paid $500,000 up front? Well, you'd still make that $20,000, but that's only a 4% return on investment. Okay, so there's the return issue there. Right now, next, consider the opportunity cost. So every extra dollar you funnel into your mortgage is a dollar you can't deploy elsewhere. So whether it's a diversified stock portfolio, you're into private deals or, rental properties for yourself, whatever. Historically, I would say it's fair to say that a balanced, investment mix is going to give you 10%, right? Or better. Comfortably, I think, outpacing most mortgage rates. I think any indices would tell you that if you're investing on a regular basis. And so basically what you're doing is if that money is in your home, it is essentially trapped, right? Home equity is trapped liquidity, and it's not really working for you. It's just kind of lazy. So that's another reason. Now, here's something else you might not have considered. Your mortgage can actually serve as asset protection, right? So creditors even including that overzealous banks, if God forbid you got behind on your mortgage, are far less likely to tap a property that still carries a lien. So by keeping a mortgage in place, you make your home less attractive as collateral and shield your equity in other holdings. So bottom line is when you run the numbers, right, when you do the math and you're very logical about this, the case for holding on to lower cost debts and investing the difference, in other words, not having a mortgage or paying off your mortgage quickly, it makes sense, right? Now, here's the thing, and this is something that I think it took me a while because when I was younger, it was just about the math. But a lot of times, it's not about the math. A lot of things in life are not about the math. There's also things that have intangible value, and intangible value frequently correlates with quality of life. So if you had zero mortgage, no monthly housing payment, no looming due dates, it probably give you a deep sense of security, right? Especially if you are kind of close to retirement. So the bottom line is there's no real correct answer here. What I would say is think about it, right? These are the things that like you shouldn't just do blindly. Know the pros and cons, weigh your financial goals against your emotional needs, and choose a path that aligns with both your head and your heart, and make that decision thoughtfully. Because if you do, at the end of the day, you're going to sleep better either way, right? I think ignorance is not bliss when it comes to matters of money. So anyway, that's my take on that. I just thought I would give you a little piece to think about. But speaking of mortgages, have you ever wondered what reverse mortgages are all about? Those late night commercials that you see often make them seem like probably just a way to rip off seniors, right? I mean, that's always kind of what I figured they were. But is there something really useful there? Well, I invited an expert onto the show to teach us all about them because that's what we do here. We try to learn about everything we can in the personal finance space. And guess what? I was actually pleasantly surprised. As it turns out, this reverse mortgage thing can be a tool for homeowners nearing retirement and something you might actually consider for yourself someday, even if you've got other money. It's not just for people who are broke. So anyway, interesting conversation I have with an expert in this space coming up right after these messages. Welcome back to the show, everyone. Today, my guest on Wealth Formula Podcast is Wade Pfau. He is a PhD, CFA, and RICP. He's leading expert in retirement income planning and is the best-selling author of Reverse Mortgages, How to Use Reverse Mortgages to Secure Your Retirement. He's also the founder of Retirement Researcher and co-host of the Retire with Style podcast. He is a PhD from Princeton, which we will not hold against him, 60 articles and 4 books to his name, and is recognized for his groundbreaking work on reverse mortgages and their role in retirement security. Welcome to the show, Wade.
Thanks, Buck. It's a pleasure to be here.
Yeah, so this is a very interesting thing. I realized that I don't really understand very much about reverse mortgages, and I I was thinking to myself, well, if I don't understand reverse mortgages and I'm sort of knee deep in real estate all the time, then probably have somebody who wants to talk who knows about it. So for those who don't know just about reverse mortgages, like what is this sort of 1,000-foot look into this? Like, what is it all about?
Mm-hmm. Yeah. To really explain that, just with my background, my focus is on retirement income, what people should do post-retirement. And it's really, how do you position assets to best meet expenses in retirement? So reverse mortgages is just one facet of many when it comes to retirement income planning. But at a high level, our home, our primary residence, is not liquid. It's hard to incorporate into a retirement income plan. A reverse mortgage is simply a way to create liquidity for your housing wealth so that you can include it in your retirement spending plan.
So I guess when people hear that, you think, well, gosh, what's the difference between that and other ways of doing that? For example, say like a home equity line of credit, for example, or a cash out refinance? Like what's the difference?
hmm There's a lot of similarities to traditional like home equity line of credit. For instance, when we talk about with the reverse mortgage, it's the home equity conversion mortgage program. It has a growing line of credit. So the first difference is simply with a reverse mortgage, the unused line of credit is growing, unlike with a traditional home equity line of credit. And then beyond that, there's additional protections. It can't the reverse mortgage line of credit cannot be frozen or canceled. So if you're thinking to use it during times of market volatility to help preserve your investment assets, a lot of the original researchers in this area, they had home equity line of credit set up for their clients. And those are frozen and canceled during the financial crisis back in
Yes.
2008. So
Right.
having the HECM helps to avoid that problem.
Okay,
And
so let's just back up because I want to do one of these. So that's a big one, obviously, like the home equity line of credit. You absolutely that is a that is one of the most ridiculous things that I've ever realized was that like as soon as you actually need it
uh
is when they'll shut it down, right?
right.
Um, but you mentioned something before that too, which was the unused portion. So basically, you're pulling out this, equity, and then the part that you use, you pay interest on,
hmm
and the part that you don't grows. Or
Yeah,
how does it
right.
grow? Like, what instrument is it growing in?
Right. The part that you're not using is growing with the same rate of interest as the part that you are using. This
Oh,
is one of I think really it's somewhat an unintended consequence that this is a program administered through the federal government. When it was created, I think the idea was people would only use these to borrow all they could right away. So then you can understand why the loan balance grows with interest. The interesting planning aspect that the financial profession caught on to with this is no, you do have to have a minimal loan to keep it open. So maybe 50 or $100 is a loan balance. But if you want the entire remainder of that principal limit, that borrowing capacity, it can be kept as a line of credit. And it's just simply growing at the same rate of interest that the loan balance would be growing. And you have
so
discretion to tap into
so
that.
you're basically are you just kind of canceling it out then? I mean, like what? Help me understand the math here, just in terms of so you're if you were borrowing half of it and half of it was growing, then you would basically net come out zero and not paying.
Well,
How
there's
does
a
it- yeah.
oh, so there's a pie. Like think of it, it's the principal limit is the borrowing capacity. And there's a few other complexities, but to try to keep it simple, we'll say the principal limit's equal to the loan balance plus the line of credit. And so that composition is always true. If 50% you've borrowed 50% line of credit, they're both the composition is going to stay at 50% each because they're both growing at the same variable rate of interest over time. And then if you make a voluntary repayment, you'll move money from the loan balance over into the line of credit and change the composition of the pie, but then subsequently it will grow at the same rates. If you decide to tap into the line of credit, take funds out, move that over to the loan balance side, you're changing the composition, but then subsequently, because they're each growing at the same variable rate of interest, uh, you're growing the line of credit piece and the loan balance piece are each growing separately on their own.
So what do you do? I mean, is this, I guess, reverse mortgages? And you kind of talked about this earlier, and usually people do it in the context of retirement. But what you're talking about sounds like something that you could use creatively for other purposes. Just for leverage and when you need some liquidity for something. For example, even for an investment that might grow at a higher rate, for example, or something like that. Is that is that something that people do?
Well, yeah, a couple of points on that. First, when we talk about reverse mortgages, and whenever we're talking about a line of credit, we're really talking about the home equity conversion mortgage program. And for that, the borrower has to be at least 62 years old. So this wouldn't be
Oh,
something
okay.
available just at any age. And then also, due to past abuses, I mean, what you said, you could use it to
Yeah.
to invest, but
Yeah.
that's risky to
Right.
potentially leverage your home equity into an investment could be quite risky. So it's generally frowned upon.
Yeah.
If the lender knew that was your intentions, they might not allow you to initiate the loan. But yes, I mean, just technically money is fungible. And so if you wanted to borrow from the line of credit to invest it, you could conceivably do that. It is a hurdle that the loan balance will be growing at a variable rate that's right now going to be somewhere in the ballpark of 7%. So
Sure.
that's not necessarily an easy hurdle to get over with an investment return.
Got it. What role could reverse mortgages play in terms of, say, tax efficiency or in various Roth conversion strategies?
Uh-huh. So because it's proceeds from a loan, it's a source of spending in retirement that does not go into your adjusted gross income. So that can create a lot of tax advantages for retirees. It's like a Roth IRA in that regard. Whenever you're selling capital gains, whenever you're taking a distribution from an IRA, that enters into your adjusted gross income. And then you have to pay federal income tax on that, state income
Right.
tax. There's other things that can impact your Social Security benefit taxation. It can impact your Medicare premiums. There's the net investment income tax. So anything that stays out of your adjusted gross income can be very helpful in retirement. And so if you need to meet expenses, rather than being forced to sell from an IRA with potentially negative tax consequences, that's where the reverse mortgage line of credit can be a resource to tap into. You could even use it to do things like funding Roth conversions if you do have some excess tax capacity where you could potentially pay taxes at a lower rate and you want to take advantage of that. Well, you got to
How
pay the
how how would
taxes.
you do that? Explain that a little bit.
Well, Roth conversion, you're going to shift funds from your IRA into your Roth IRA to keep it simple. That will generate ordinary income. You have to pay taxes on that so that you don't have to like take a further distribution from your IRA to pay the taxes, or so that if you want to preserve your taxable brokerage accounts and you don't want to pay the taxes from there, using the reverse mortgage as a source of funds to pay those taxes
Uh-huh.
is a potential legitimate use of the
Yeah.
reverse mortgage line of
What
credit.
kind of interest rates are people typically paying? Like, I was just thinking about, again, you talk about sort of this balance, and if you're borrowing over, no, if you're borrowing over 50%, you're going to have to net pay a price for this money. How much? Like, how does that work?
The variable rate that the loan balance and the line of credit would be growing at, it's going to be linked to a short-term interest rate, such as a 1 month or 1 year treasury. So that right now is somewhere, I think, a little bit shy of less than 4%, plus a fixed lender's margin that's part of the loan contract. That could be anywhere from 2 to 3 to 3.5%, and then plus 0.5% for mortgage insurance. So right now, somewhere in the ballpark of 7 to 8%, somewhere in that range would be what someone would be
Yeah,
looking
it's
at
not
as
cheap. Yeah. Um, is there a way to leverage a reverse mortgage to protect an investment portfolio during down markets?
yes. Now that's the getting into the retirement income discussion.
Okay.
With retirement, so pre-retirement, when you're saving, market dips can help savers because they get to buy more shares with their savings. That reverses post-retirement. If there's a market downturn and I have to sell from my portfolio to meet expenses, I have to sell a bigger percentage of what's left, or I have to sell more
Yeah.
shares to meet expenses. That can dig a hole for the portfolio that becomes harder to recover from. This is called sequence of returns risk. So in the early, well, actually in 2012, two research articles were published about the idea of using the reverse mortgage as a buffer asset. So that line of credit doesn't decrease in value, and it can provide a temporary resource to spend from to meet your retirement expenses without having to sell from your
Yeah.
portfolio. And so,
So
yeah,
you're
that
riding out a bad market by basically tapping into the equity in your house, which presumably is, you're not losing anything there if you're just using that instead until things recover, right?
right. You let your portfolio have a better shot at recovering. And that's the huge benefit what led me down this path of looking at reverse mortgages. At the end of the day, the legacy you leave at the end of retirement, to keep it simple here, with what's left in your investments plus the value of your home minus the loan balance due on the reverse mortgage. And all the research in this area points out how by helping to manage the risk around taking distributions from your investments at inopportune times, the growth to your investments can more than offset the costs and the loan balance of the reverse mortgage so that you have a bigger net legacy at the end of
Yeah,
retirement.
I think that's a good point, because I think, my when I think about this, the first thing I think is, well, gosh, those kids are probably not super happy that their parents are using, you know, reverse mortgages. But I guess your point is, well, yeah, but they're preserving the rest of the portfolio, and that's gonna. You're saying that studies show that actually ends up leaving a better or bigger legacy than if they, tapped into that portfolio in down periods.
Right, right. It provides a windfall of instead of gifting the home to the kids who may not really want it anyway and just end up selling it, you're gifting them liquid investment assets that are worth more than
Yeah,
just having
yeah.
left the home without any use of a reverse mortgage.
In terms of estate planning, while we're on the topic, what kind of strategies would pair well with reverse mortgages? I mean, would you, want to use some kind of a trust, or how would that work?
It's fine to have the home in a trust and you're still eligible to use reverse mortgage. Uh, it's not necessarily an area where there's like interesting estate planning strategies per se. The loan balance becomes due. It is a non-recourse loan from the perspective of estate planning, so that if you borrowed quite a bit from the reverse mortgage, you've had the loan for a long period of time, it's possible the loan balance will be greater than the 95% of the appraised value of the home. And if that's the case, the beneficiaries can simply just hand over the keys, a deed in lieu of foreclosure.
Yeah.
If the loan balance is less than what the home can be sold for, the beneficiaries can have up to a year by coordinating with the lender to either, if they want to keep the home, to refinance the reverse mortgage into a traditional mortgage, or simply sell the home, pay off the loan balance, and then whatever remains is part of that legacy.
So that's interesting. I guess just to kind of say something that caught my attention there is, if you basically tap this whole thing out, and all of a sudden there's a down housing market, and you die during the down housing market, your heirs don't have to pay for that, and
Right.
they may end up getting more than they actually in value should be getting.
Yeah, there's a lot of insurance advantages of reverse mortgages. And the one we're touching upon now is it provides insurance against a decline in home values, because once you've opened the reverse mortgage, that line of credit grows independently from the value of the home. And if the home depreciates, it's all the easier to enter into that non-recourse situation where, and if your line of credit's worth more than the home, and you've got to be alive to do this. You can't just push it off forever, because if you suddenly pass away, it's too late. But you can take the windfall out of the line of credit, and then all that's going to be due at the end is the 95% of the appraised value of the home.
Could this just be a smart way to access equity without triggering a capital event, and paying taxes too? I mean, do some people look at it that way?
Yeah, that gets into just, so investments are liquid. You can sell from your investments to meet expenses. Whatever you sell from your investments is now gone, so you don't benefit from any subsequent growth. Well, I think of the reverse mortgage in the same way, that you have this home that's not liquid. You can't just spend from the home without selling it. But if you want to live in the home, you can't just spend from it. But the reverse mortgage gives you a way to spend from the value of the home and to coordinate that with spending from investments or other income sources.
What are like some of the risks that people need to be aware of?
So you do have to maintain homeowner obligations. You have to have homeowners insurance. You have to pay your property taxes. You have to do basic home maintenance and upkeep to preserve the collateral value of the home. If you're not doing those things, the loan can be foreclosed upon. And that's an important consideration. Now, most of my focus is on using reverse mortgages as part of a responsible retirement income plan throughout retirement. How they're often used in practice, and this is where you get into some of the risks too, it's a last resort situation. People have depleted all their resources. They have their home, they want to stay in the home, so then they tap into the reverse mortgage. But then if eventually they've spent down the proceeds of the reverse mortgage and then they don't have any funds left at this point to pay property taxes and so forth. That could lead to a foreclosure. And then also the other kind of negative media coverage is just related to more like these last resort situations, but where children were expecting to inherit the home and then found out their parents decided to use the home equity for their own retirement spending instead of leaving it to the kids. So the negative media story is the kid is horrified that they lost their inheritance. But the reality is, no, that was the parents' home, and they decided to use that as part of their retirement spending plan.
Right, right. And in that regard, is there a case to be made that not using home equity in retirement is actually a form of inefficiency?
Yes. The default people kind of get into with home equity in retirement is just kind of ignore it, or you treat it as the last resort. It's a reserve. If everything goes wrong, then I'll figure out what I'm going to do. Either I'll sell the home or I'll open a reverse mortgage much later on. And if you compare that to, you do have to be 62 to have the reverse mortgage, but once the oldest person, or if they're close in age, wait until the youngest person reaches 62 as well, open the line of credit at that time and let it start growing. Yeah, the research points to, in the majority of cases, having a more efficient outcome for that retirement, being able to better meet your spending goals throughout retirement. And then if you have met all your goals, having more legacy to provide at the end of retirement as well. So that's what efficiency is all about. And yes, the research really points to coordinating with home equity in a more efficient manner throughout retirement, rather than leaving it on the sidelines as a last resort if all else fails at the end. Can give you get a better outcome by coordinating more efficiently throughout retirement.
So, like most of the time when people see or hear about reverse mortgages, it's in the middle of the night. There's some sort of commercial that's basically, they're trying to get older people to do this. And so it's got some negative connotations to it as well. Particularly, I think, for people who think that it's for people who, like you said, it's sort of like their, cash of last resort. Could reverse mortgages be you think that they're underused by the affluent because of, basically outdated stigma, or maybe not knowing the facts?
Uh-huh. Yes. So if they're very affluent, the lending limit, you can only apply the reverse mortgage to up to, it's getting close to $1.2 million of the home's value. So for the extremely affluent individuals with multi-million-dollar homes.
You mean 1.2 million of a
of the
line, or
No, of the home's value.
the home's value? Okay.
Now, there are some proprietary reverse mortgages as well that are popular in places like California, where many people may have mortgage balances that are still a couple $1,000,000.
Yeah.
But for the HECM program, that there is that limit. But yeah, for
What's
the
that?
mass affluent, where they have an investment portfolio, but maybe the home is worth just as much, if not more, than their investment portfolio. Those are the kind of cases where it is underutilized because they're just not getting the efficiency that being able to have that larger percentage of their asset base in home equity as part of the planning is really valuable. There's a study done by Mark Warshawski, who went through and looked at like the entire population of age 62 plus people. And that includes people who don't own homes and everything, who are not eligible. You need to own a home as a very starting point. But he estimated 14% of eligible of retirement age Americans could benefit from reverse mortgages. And right now the utilization rate is only around 1%.
Yeah, absolutely. Interesting. What else am I missing on this topic? Again, it's not something I know much about, but is there anything else that you think is important to know?
Oh, well, I think we have touched on quite a bit now. It's the HECM program. It's the more than 90% of reverse mortgages. I should mention that the line of credit is available with the variable rate HECM program. There is also a fixed rate HECM program. At this stage, less than 1% of HECMs have the fixed rate, but it doesn't have a line of credit. It's only the variable rate. So don't make the accident of expecting a line of credit if you use the fixed rate option.
And just to be clear, you're saying, like you said, a home of 1.2 million. So for most people who are, if they got like 30%, I mean, we're really talking about like 300 grand or so, up to 300 grand or so, right? I mean, that's kind of I mean, if somebody had $1 million house in California, which, obviously that doesn't even buy very much in California. And they, could they do $1 million thing if they own their house outright?
Uh-huh. Yeah,
Yeah.
and you could have
Yeah.
a $5 million house and still use the HECM program. It's just your line of credit would only be
Yeah.
based on the 1.2 million.
Yeah.
That's not the exact number. Every year it changes. Can't remember right offhand what this year's value is. It may be
Yeah.
closer like 1.15 million.
Right. But help me understand that though. If somebody has, let's say it's a $3 million house, um, because you said the value of it has to be based on the value of the house up to like 1.2 million. So
Approximately.
if somebody had 1.2 million or approximately 1.2 million of equity in that house, they would be able to use that whole 1.2 million.
So part of the HECM program is you can't have you can pay off an existing mortgage, and that's actually a common use. Rather than carrying a fixed
Oh,
mortgage payment into retirement, you use the reverse mortgage to refinance and take that fixed mortgage payment out. But you can't have another mortgage and a reverse mortgage at the
you
same
can't.
time.
Oh, so this has to be without. Oh, so this is for people who own their house outright.
Well, or who actually the most common use is to refinance the mortgage. Say
Yeah.
I've got
Okay.
$1 million home, the principal limit maybe $400,000. I
Okay.
still have $200,000 on a mortgage. In that scenario, I could open the reverse mortgage, uh, put the old mortgage into it, and then I still have $200,000 left as a growing line of credit. And
I
I've taken
see.
that fixed mortgage payment out of my budget for those early retirement
Got it.
years.
Interesting stuff. Wade, the book again is Reverse Mortgages, How to Use Reverse Mortgages to Secure Your Retirement. Obviously, you do a ton of other stuff. You have a podcast, Retire with Style podcast. And I want to thank you so much for being on Wealth Formula Podcast.
Absolutely. It's been my pleasure.
Be right back. Once again, conversations about, paying off your house or estate planning, asset protection, ways of generating cash flow. These are great questions for our private community, which if you would like to join, go to wealthformularoadmap.com, download that free course. It's a great course. And then, join our group for a month for free and see if you like it. Anyway, that's all I have this week on Wealth Formula Podcast. This is Buck Joffrey signing off.